Hello, and welcome to the presentation and discussion of the 47th Statement of the Latin America Committee on Macroeconomic and Financial Issues, CLAAF for its acronym in Spanish. I'm Liliana Rojas Suarez, Director of the Latin American Initiative here at CGD and Chair of the committee. I am accompanied by some of the committee members and authors of the statement. Let me introduce them in alphabetical order. José de Gregorio, Dean of the School of Economics and Business from the University of Chile and former Governor of the Central Bank of Chile and former Minister of the Economy, Mining and Energy of Chile too, of course. Pablo Guidotti, Professor of the Government School, University of Torquato di Tella, former Vice Minister of the Economy in Argentina. Paulo Leme, Chairman of the Global Asset Allocation Committee, XP Securities, former CEO and Chairman of Goldman Sachs of Brazil. Ernesto Talvi, Senior Fellow, Real Institute Elcano in Brazil, and also former Executive Director of Ceres and former Minister of Foreign Relations from Uruguay. And finally, Andrés Velasco, Dean of the School of Public Policy from the London School of Economics and the former Finance Minister of Chile. We'll start this program with a brief presentation of our statement. This will be followed by a discussion with CLAAF members. So it would be great if we can have the slides now. We have called our statement Latin America, adapting to the new global financial environment. So let me first show very briefly how we see the financial and the global environment evolving. The bottom line, to make things fast, is that the global financial outlook has improved. Next, and there are a number of indicators to show this. First, IMF indicators of US trade policy uncertainty, although still remain quite elevated and, as you can see, highly volatile, have declined significantly from its peak in April of this year. But basically, the extreme fears of a trade collapse have not materialized. Next. Second, indicators of volatility in the equity market, such as the VIX index on the left, and in the US Treasury market, such as the US Move Index on the right graph, have also declined relative to previous peaks. In addition, many of the commodity prices, especially those that Latin American export, with the exception of oil, have also risen to historically high levels. Next. Now, consistent with these indicators, risk spreads in emerging markets in general and in Latin America in particular have compressed significantly, as we can see in the graph from the behavior of the MB Diversified Latin American Index. All of these behavior have occurred during the during the previous year. Next. Well, if you have lower costs of borrowing, you also have an increase in the quantity of borrowing. And what has been happening is that these lower borrowing costs have been accompanied by an increase in capital inflows to Latin America. So as you can see from the graph, after the reduction of inflows in April, May of this year, inflows have shown a significant increase. Given that there are lower interest rates in the US, inflows have concentrated in bond markets. And this, of course, reflects a search for yield and expectation of a strengthening of domestic exchange rates relative to the US dollar. Next. Something very interesting is what's been happening with tariffs. The impact of US import tariffs on the region has been very limited so far. Although the reciprocal tariff announcements were very high for some countries, when we want to analyze what is the actual impact, that depends on two factors. First is the effective tariff rate, which actually we're showing in the graph in the vertical axis. And the effective tariff rate is defined as the announced tariff adjusted for exceptions, tariff exemptions for a number of products, and sector-specific tariffs, such as those on steel, aluminum, copper, and automobiles. That's one part of the impact. The other factor that impinges on the impact of tariff is the extent of each country's reliance on the US market. Potentially, of course, countries could be more affected if their share of exports to the US is large. Now, the graph here shows a very interesting pattern. As you can see, I've drawn a 45-degree line. Again, the effective tariff rate, the one that is adjusted, is on the vertical axis, and the reciprocal tariff, meaning the headline tariff, the one that is announced, is on the horizontal axis. So most Latin American countries, the countries shown there are all Latin American, most Latin American countries are on the right of the 45-degree line. What this indicates is that their effective tariff rate, meaning the actual tariff, is lower than the announced reciprocal rate. This happens because of the large exemption of tariffs, especially the recent ones that were announced on agricultural products. Mexico is kind of the perfect example. As you can see from the graph, the announced reciprocal tariff is 25%, but most of its exports to the US are accepted because of the USMCA treaty, so the trade treaty between the US, Mexico, and Canada. The exception of this pattern is Brazil. Very high reciprocal tariff, 50%, and relatively few exemptions means that Brazil is facing the highest effective tariff in the region. Although I have to add that the effect is contained because of Brazil has a limited share of exports to the US. Next. Now, I've been talking about the positive outlook in the region, but of course it's not free of risks. There are a number of structural risks. Number one, the policy shift by the US administrations may lead to a durable dislocation of the multilateral trade and financial architecture that was established after World War II. These risks could materialize if tariffs are used to keep redirecting supply chains back to the US, right, on a sustained and permanent basis. Second, although CLAAF does not take any position about the role of the US dollar as a dominant currency, the persistence of the US dollar as a dominant currency, we recognize that the large and increasing stock of debt in the US, combined with the heightened geopolitical tensions, could actually place sustained pressure on the value of the dollar. This, in turn, could pose risk to the stability of the global financial system. And if we are talking about risk to the financial stability, the committee wants to raise the attention to some early warnings that emerged last October from the less regulated, highly leveraged segments of the financial system, especially what are called BDCs, which are the business development companies, and also private credit institutions. These are financial institutions that are highly exposed to commercial real estate. What happened is that the bankruptcy of a number of firms that had borrowed from BDCs led to a sell-off of BDCs in mid-October. They are important, and what we are most concerned is that there are important links between the BDCs and the large global banks. So monitoring these risks is extremely important in the eyes of the committee. Next. And of course, there is also the important and well-known risks in the stock market, right? That's what makes the headlines almost every day these days. So looking at investors' expectations about the performance of companies in the future, one could ask, and this is what we are showing in the graph, one could ask, how does a company next 12 months price earning ratio today compares to its own historical next 12-month price earning ratios over the past 12 years. So basically reflecting what are the expectations of the companies, of investors regarding the price earnings of the companies. So what we observe that especially for companies in the Nasdaq 100 index, those expectations on price earnings are to the roof. The market is expecting a strong growth in the technology sector. Failure to deliver on these expectations would most likely lead to a significant drop in stock prices. The problem, of course, is that a sharp correction in asset valuation leads to an increase in risk aversion and therefore a reversion of capital flows to emerging markets and also to the region. Next. Okay, so this is the overall environment, right? So how should Latin America respond? Clearly, the general answer needs to be to try to take advantage of the currently favorable environment while minimizing potential risks. So to this end, CLAAF advances a number of recommendations. I would go quickly through them and then we'll discuss them further with the other members of the committee. Our overarching recommendation, right, the first one that comes is what everybody, of course, would agree, is that this is a good time for countries to reinforce their external, fiscal, and financial buffers, basically to be ready for potential global shocks. But we also advance recommendations in 3 areas, and that's what we are going to focus our discussion. Trade relations, the supply of natural resources, and public sector's assets and liability management. Next. So going on trade relations first, right? We see now an opportunity for Latin America to enhance its trade arrangements with the European Union. So what is happening is that facing the shift in the US administration towards its NATO allies, the European Union has been redesigning its global trade architecture to strengthen its own resilience, the resilience of its supply chains. So for this purpose, the EU has accelerated negotiations to expand their trade agreements with a number of countries in the world, including with Asian countries, India, Australia. So CLAAF believes that the complementarities between the European Union and Latin America makes them ideal trading partners. Latin America, on the one hand, has the critical minerals and renewable resources, energy resources, that Europe needs for the green transition. And the European Union, in turn, can offer capital and technology to promote high value added by regional production chains. So if the Mercosur trade deal is ratified, the European Union network of trade agreements with Latin America will cover 97% of regional GDP, which is a much larger coverage than the US and China. So now, in spite of all this, there is a problem. Even if we have all these trade agreements, the trade agreement between Mercosur and the European Union, and even if the European Union signs further agreements with other countries, there is a problem. There is a fragmentation of the rules of origin regimes, which makes it very costly to combine input from different countries. This, of course, is limiting the creation, or would limit the creation of the bi-regional supply chain. CLAAF, therefore, is endorsing a new proposal advanced by Ernesto Talvi and colleagues, which Ernesto is here with us, part of CLAAF, which established a so-called flexible diagonal accumulation mechanism. I let Ernesto go deeper into this mechanism, but the bottom line is that if, for example, you have 2 countries that have bilateral agreements with the European Union and also with each other. So those two countries also have trade agreements with each other. In that case, the input from both countries can be treated as originating without having to modify the specific rules of origin of each treaty. That's a proposal. We'll discuss it further. Next. A great news about the benefit of this proposal is that implementation of the mechanism could be key for the creation of a really integrated EU Latin America by regional economic area, which could boost regional trade by 70% and intra-regional trade by 40%. Now, it's important to stress, and the committee made this very clear during our discussion, that our support for improved trade relations with the European Union does not preclude in any means that we are discarding better arrangements with the US. On the contrary, we actually believe that the region would benefit from better arrangement from both partners, and we actually hold a positive view regarding the recently announced framework for trade agreements between the US and a number of countries in the region. Next, please. So, on Latin America's own integration, the committee has made recommendations in this area in previous statements, several of them, and actually I would like to invite you to revise them. They are all in our webpage, which is just use the opportunity, claaf.org, CLAAF.org. And we think that for improving the Latin America's own integration, multilateral organizations could play a key role in supporting this integration. In particular, our emphasis is on infrastructure integration and the mining of minerals for the green transition and for development more generally. So, in the view of the committee, the exploration, extraction, and processing of minerals cannot be done without large-scale FDI in all process of mining. So, for this, as well as for attracting infrastructure finance, it is essential to harmonize legislation and regulation between countries. And again, I don't want to expand on this issue that we have treated many times in other statements. Next. Finally, we believe that for dealing with the risk in the global financial environment that I've been discussing before, central banks and governments should use the opportunity of the current positive environment, the positive climate environment, to implement some asset liability management. On the asset side, our recommendation is that central banks could take actions to mitigate the risk from large movements in the US dollars. The graph that you can see on the screen shows the behavior of the real effective exchange rate for the United States. You know, when we talk about real effective exchange rate, there's really no agreement on what is the value, what is the optimal value, whether how much a currency is overvalued or undervalued. But there is a general agreement that there is some dollar overvaluation, and some estimates placed this overvaluation in around 10%. We'll also discuss this recommendation with some members of the committee in a moment. Just let me say that we recommend diversification of international reserves before holdings of US dollars and to include other hard currencies such as the euro, yen, and pound sterling. And we also recommend that central banks actively manage the duration and composition of their holding of bonds issued by advanced economy. And here we mean managing the composition of instruments between those that have fixed and those that have flexible interest rates. Next, and on the liability side, our recommendations are for sovereigns. The first one on the asset side recommendations were for government, for central banks, These are for sovereign. So our recommendation in this area on the liability side called to optimize the currency and legal structure of external debt. This could be done by issuing debt under a diversified set of jurisdictions, such as the UK or Japan, and not only New York. Also, adjusting the duration and rate composition of the external debt when needed, and if clear changes in the direction of the US interest rates emerge. And also consider tender offers to be able to renew the debt, to retire legacy bonds, and issue new instruments. So that's in a very quick manner a summary of the recommendations from our report. Let me now bring some of the other members to the discussion. So if we could please put down the presentation and bring back our committee members. So Pablo, let me start with you. In the statement, we argue that the region should take advantage of the current favorable financial environment. However, we've seen a lot of volatility in the last year. What probability do you attach to the continuation of this positive environment in 2026? You think you can identify factors signaling a continuation of the current stance? This is very important, right? Because our recommendations for reform will take time to implement.
Yes,
Right.
thank you, Liliana. I think that certainly we can always have volatility and risks, but I think that emerging markets in general and Latin America in particular has been facing an improving scenario, external scenario, and better capital market conditions during during the second half, I think, of this year, after probably 3 years, which is a record of outflows from emerging market economies. So I think that the main reasons why we can be optimistic. I think that first of all there is much less uncertainty about the effects of tariffs. In terms of if you look at the U.S. economy, I think that the calls for recession now have almost disappeared, and in fact the economy is picking up pace. And maybe the main question is whether or how long will it take for the labor market to actually also start to recover into the future. Also, I think that the impact of tariffs on U.S. inflation has been very subdued. So we can expect a relatively stable environment for the Fed policy. Today we have, of course, a very important FOMC meeting, and we'll have to see how it goes. But the market expects with almost certainty an additional 25 basis points cut, and probably looking into the future, probably the number of cuts that we can expect are going to be lower than what were thought when people were expecting a much weaker pace for the economy. So I think that the conditions coming out from the U.S. economy, which are very important for emerging markets, are likely to be constructive, and unless we have black swans coming from the risks that you have identified, I think that external conditions for emerging markets and for Latin America are going to be positive. In Latin America, moreover, I think that there are several political cycles that are ending or that are in the process. I think that, well, we have seen a major turnaround in Argentina in terms of improved economic policies. We have now elections in Chile and Colombia, which probably are going to bring about more market-oriented policies, and possibly we'll have to see there is a little bit more uncertainty regarding the elections in Brazil, but next year. But I think that in general, the cycle of the political cycle, in my view, is pointing to a better macroeconomic policy environment with a more conscious view that deficits have to be lowered and fiscal responsibility is important. And I think that the region, in that sense, is very well placed to take advantage of the current situation.
Pablo, that's a very, very optimistic view of the future. So let me, Pablo is one of the most optimistic members of the group in all these regards. So, Pablo, I don't see you, and I wanted to ask you a question. Are you there? Yes, there you are. You're muted, I think.
Yes.
Okay, now you are. So let me ask the opposite question for you, right? I asked Pablo about what are his views about the favorable, positive environment and the probability of that continuing. So let me ask you, what probability do you attach to the reversal of good times? So it's the opposite view, right? Which of the risks that we have mentioned worry you most? And are your concerns shared by the consensus of market participants, or is there a divergent view in terms of prospects?
Yeah, well, first of all, thank you for leaving me the hard question. So I tend to agree with Pablo. I think that the probability of the best case scenario, I think, is very high, in the order of 70%, 75%. And this is quite remarkable in terms of market consensus. The dispersion of the forecast is minimal. Maybe it's because we don't know the final effect of all the changes in policies, productivity changes from AI, what's going to be the final result of all of that. But it's almost like you're copy pasting this year into 2026. And I think that the conditions are for a continuation of good macro background and with a decent financial market performance across asset classes. So I would treat the downside more like risks. And I think that the balance of risk is to the downside. I think that the combination of asset prices valuation, as you showed, and it's not only in stocks, but also in credit, you're at the upper percentiles. And as you have this immense amount of liquidity out there, and you went through all asset classes, and now everything became expensive. So what you have seen is two things. A is that you are sitting in things that have probabilistically, when you look at the distribution of expected returns, your upside is small relative to the downside that you have. And historically, that's exactly what we have. Occasionally, intra-year drawdowns, which is like one standard deviation movements, let's say for equities, 12%, 14%, and then it recovers. We call those intra-year drawdowns. Now, the concern that I have the most is as assets became very expensive and you still had that liquidity, you started to go into the less regulated sector, especially in the areas of private credit and also real estate, particularly commercial and also industrial real estate. And two things or three things are very concerning. One is that you went very sharp down the credit quality ladder. So, and also second, the standards of underwriting deteriorated significantly. This is what you saw, as you said, with the BDCs. with Tricolor, with First Brands. I think it was like the due diligence in the underwriting process perhaps was not as robust as it should have been. And how much of that is out there? I think without a stressor is not going to manifest itself. But with if we were to have policy mistakes, and this takes me to the main conclusion, is that I think that we're like in steady state with growth, but I would say there's going to be a major change at the Fed. This could lead to changes in monetary policy towards a much more dovish, monetary policy. And then with growth, you could end up having more inflation. So to me, the biggest risk of all of this is A, higher inflation, and then B, a Fed having to chase higher inflation. And then that's when things unravel. So I think, recessions, they don't come out of the blue. So bearing, an exogenous shock, it's policy induced. And I think we may have a combination of monetary policy and fiscal policy induced need to tighten. And that's when you could have an unraveling of equity markets adjusting, bond yields going up, and then the other alternative asset classes, particularly private credit and also real estate experiencing problems. But I don't sense anything systemic a la 2008 by far. But I think you would have a drawdown on a cycle that it's going to be reflected in capital flows and into Latin America as well.
Paulo. So the emphasis is on risk. You see the probability low, but the risk is still there.
Yes. Again, as I said, is like when you look at where we are in this business cycle, so we are much higher in terms of number of quarters of expansion. So I think you're in a very late phase. You have a lot of imbalances, particularly in public debt across advanced economies. And you're going to have some policy experiments if the other governors that are there allow them to do it, which is to take the terminal Fed funds rate to a much lower level than we have seen, as written by Governor Myron. His idea is 4%, 2%. And I think that could, in an economy that's still growing, as Pablo mentioned, I think it could overstimulate, take you above potential GDP, overheat the economy, and then that's the typical stop and go that unravels. So I think it's more like a risk, and certainly to me is not the central scenario.
Okay, great. So, Jose, we've been talking a lot about the international environment and its effects on Latin America. So let's now look at the Latin America economies themselves. So if you take into account that the region is really very diverse, do you think that it's in a better position to weather the potential shocks that we have discussed? You're muted.
Sorry.
Yeah.
Sorry. I was looking at the data, but it's that. I think that is what's important about the international environment is always with some risk. We have seen this year something that's kind of unusual for the kind of crisis that we have been used. We were used to financial crisis. We have the pandemic. Now we have a crisis, or I wouldn't say crisis, but turmoil coming from the central country in the global economy. So the issue is whether economies are better or less prepared to face risk and turmoil. And that's I have a relatively positive view in the sense that Latin America, central banks, even sometimes regardless the political sign of the governments, they have been able to have a macro framework that has been quite resilient. We were extremely resilient to perhaps the worst crisis that we had. That was a global financial crisis. I think that crisis, after that crisis, it kind of consolidated good macro policy. People realized that emerging markets could do what grown-up countries could do, which is basically to loosen when you have a crisis without contaminating the financial system. then we had COVID. Now we face, and this is also important, we face a period of very high inflation rates all around the world. And with some disparities, countries have been able to control inflation. Perhaps the main challenge today is that we haven't reached the target of inflation. Still, inflation went up, many countries to 2 digits. It came down in a couple of years, but still we haven't achieved the inflation target as it was pre-crisis. But this is, I would say, the last mile challenge rather than the big view that we have that inflation was controlled. So first of all, I think that it's a extremely, from the central bank financial point of view, Latin America is and emerging markets in general are quite strong. Where can I see, and financial systems, but where can I financial systems that were extremely tightened and put under stress during the COVID crisis, they were able to function relatively well with the appropriate policy support. Where I see perhaps the main warning is on the fiscal side. Why? Because since the global financial crisis, we have been accumulating debt. Debt has increased. Countries are much more exposed with high levels of debt. So large and persistent fiscal deficit will deteriorate this, and at the end we can have financial shocks on the quantity side, or interest rate shocks that could derail and put in danger fiscal policy. As of today, countries have been able to manage the current levels of debt, but there are always, I think, the risk, and it's where I would say the warning is more relevant. Thank you.
Thank you, Pepo. So let me now turn to trade issues. And for this, I'm going to involve a conversation with Andres and Ernesto. So Andres, first to you. In our statement, we place a very strong emphasis on the importance of trade integration for the region. Now, I have a question in the chat that says, why do you think the coordination among countries willing to integrate has not happened yet? So we talk about integration, but it's not happening. So what are your views on that?
Hello, everyone. My views is that this is very important, but of course, we've been working on it for about 200 years. It hasn't quite happened yet for a number of reasons, some political, some having to do with practical things like lack of infrastructure, but most fundamentally because you had very, very divergent macro policies. So it's very hard to integrate with a country next door where the real exchange rate is jumping around all the time, and therefore, you know, the relative prices are one level one day and a very different level the next day or the next month. I think that's the bad news. The good news is that I think, touch wood, we're facing a more stable macro environment across Latin America, and this is particularly true as a result of the Argentine stabilization. And if other countries with fiscal challenges, as colleagues have mentioned, stabilize their fiscal situation, then you could have much more stability and homogeneity of macro and especially of fiscal policies across the region. And that opens up an opportunity for greater trade. I think that's the first opportunity. The second opportunity is simply that with the United States in love with tariffs and with geopolitics and tensions between the US and China becoming the dominant force, then the incentives for Latin America to trade more within the region rise. When you have guaranteed markets abroad, maybe you don't need your neighbors. When you no longer have guaranteed markets abroad, your neighbors suddenly begin to look a bit more attractive. So maybe the worsening of the trade environment in other places could have the surprising but not entirely unprecedented effect of enhancing local integration. It's not a done deal. We've tried it before. It didn't work, but I think there's an opportunity right now.
Andres. Ernesto, so you do believe in trade integration. You believe that trade integration between Latin America and the European Union is a great positive move for the region. And you have a very interesting proposal. But I suspect that when I mentioned your proposal to establish a flexible diagonal accumulation mechanism, I may have confused or lost some of our audience. Could you please explain the essence of the proposal in very simple terms?
Okay, Diana, thank you. This proposal has been put forward by together with my Rafael Cornejo and Antonio Esteban de Ordaz, has been published Instituto Elcano and the Americas Georgetown Institute, if you want to in detail. But the essence is simple. If ratified the EU-Mercosur agreement, the EU will have bilateral FTAs with 90 in America's GDP. Mexico, Central America, Colombia, Peru, Ecuador, and Mercosur. Now, the problem is these agreements are not interoperable because of the fragmentations of the rules of events for final products to enter any country with preferential treatment. So what's that relation of origin does for us? And then I'll go into the flexible part of the origin. Let me work with an example. Let's assume, and not assume, Mexico as with the EU, and they have an FTA between themselves. Now, if a Chilean lithium product were to be used by electric bus assembly company in to be to the EU, that lithium process component would not be as part of the Mexico agreement. What cumulation of origin does, it allows for a third party, in this case Chile, that has an agreement and with Mexico, its inputs to be considered as if it were the EU, Mexico purposes of entering with preference into the European Union. That's the essence of cumulation, that you allow thirds to enter into the triangle with their own inputs without losing any preferences. The flexible comes because the proposal we are putting forward don't need to harm origins of the different agreements, modify any product-specific rules of origin. It will limit it to the universe in each triangle that are called three agreements, and therefore this would be like a variable geometry where each triangle of countries defines a universe of products that are benefiting from these mechanisms. Because the adoption of a protocol in order to allow for accumulation of origin could be incorporated as an to existing agreement without reopening negotiations. So this is a very pragmatic, high-impact solution to develop an integrated bi-regional economic area, European Union and Latin America, that would allow for the development of high-value, decarbonized supply chains, the development of the infrastructure of artificial intelligence, and the creation of an economic area, 1.1 billion people, and a GDP equivalent to that of the US. So, but a relatively minor one compared to what we've already accomplished between the two regions.
Thank you so much, Ernesto. Andres, back to you. Please wear your hat as a former Minister of Finance and give us a brief comment on Ernesto's and colleagues' proposal. How do you see it from the country, from the region?
I think it is an absolutely wonderful proposal from both ends. From the point of view of Latin America, it is an opportunity for us to harmonize our own agreements with the European Union. And that, of course, helps harmonize trading relationships, not just with Europe, but also amongst ourselves. Given, again, the more challenging environment for trade in Asia or trade in North America, this is a great opportunity. That is the view from the South. Now, I'm sitting in London, and not quite in the European Union, but let me say something about the European perspective on this. As Europe looks around the world, Europe finds that its longtime ally, the United States, is not quite as reliable and not quite as predictable as the United States used to be. And as the European Union looks east, it sees a very, very challenging scenario with Russian aggression in Ukraine and with geopolitical tensions in Asia. As a result, Europe wants friends, wants trading friends, but also geopolitical friends, and even better if those geopolitical friends are democracies. And I think South America, in this respect, offers a tremendous opportunity. It is a large continent. Each country's individual GDP is not gigantic, but you put them all together, and it is 8% of world GDP. And in addition to that, most countries in South America are democracies. They're committed to human rights. They're committed to the kinds of values that Europeans hold dear. So both from a trade point of view and from a political and geopolitical point of view, this looks very good from Europe. And this, of course, looks also very good from the point of view of the UK. So low-hanging fruit. Kudos to Ernesto and his team for having put this together. And I very much hope we take this opportunity and run with it.
Great. Thank you, Andres. Back to you, Ernesto. Final question on this. We need to make it brief because now we we don't have too much time. So, we need ratification of the European Union Mercosur trade agreement for the success of your proposal, right? However, because just as a background, the EU and Mercosur have been in negotiation for some time. They have, on the 6th of December, they signed an agreement, but it needs ratification in Congresses. But in some European parliaments, including France, they have shown to be not very enthusiastic about this trade deal. What are your views about the success of this trade agreement between the two regions?
Look, Liliana, the European Union is a important institution. It's 27 countries and with very different interests, and nonetheless, it seems to work. Not perfectly, but work as an institutional architecture as it is. When it was against the ropes, the European Union has always moved forward into deeper integration. So optimistic, although we'll see that since this is such an obvious relationship to develop current geopolitical context. We are going to make virtue out of necessity, and hopefully will be approved, even though there will be a lot of resistance, especially in the parliament. And if we do, then we have a great chance, Andres, that South America is a great candidate, not democracies, but, and with this I finish, Europe is the most important investor in the region. Europe is the most important with which human relationship, and this is less known, the most important provider of military for our, not the US. So a lot they're going for this strategic alliance, and we have a great opportunity to make it happen.
Thank you so much. So now let's turn, because we are really running out of time, so let's turn our final discussion, the last few minutes we have, about the financial issues in our recommendations. And for that, I'm going to bring Paulo, Jose, and finally Pablo. So, Paulo, how important, and please keep it short, I'm going to go a few minutes beyond time, but I cannot go too much above. So, Paulo, how important do you think is that sovereign governments optimize the currency and legal structure of external debt? Put on your private sector hat and tell us how markets would receive the implementation of these policies. You're muted.
Yes, sorry. I think, let me take one step back. I think, first of all, any government like CFO should have a view. The changes that are potentially coming in terms of inflation, in terms of interest rates globally, particularly because of debt and treasury issues, are very high. So you have to have a view in terms of where interest rates are headed, where exchange rates are headed, and where the U.S. Treasury yield curve is headed as well. So, going to your point in terms of, I think that in terms of reserve management, you have to calibrate the proper currency composition. For example, this year, if you had too much dollar exposure, you underperform relative to a manager that had a high non-US dollar exposure in fixed income and bonds. And you have to adjust the currency composition to your patterns of trade as well. Also, on the asset side, managing duration, I think, is key, because if I think interest rates could rise at some point and the yield curve steepen, so therefore, as an issuer, you would like to have the maximum maturity. So if you think that rates are going to rise, so you issue more. And I think investors are going to take it very well. So I think in general, particularly real money investors, they like proactive public debt management offices in Latin America that are ahead of the curve. And as the environment changes, so will portfolio managers' priorities, and they like to see products in terms of currency denomination, in terms of maturity, in terms of duration, whether it's fixed or floaters. So I think that it will go reasonably well. And as always, the public debt office should always work in tandem, in coordination with the investor.
Okay, so next, Jose. Paulo talked about the advantages of the sovereigns optimizing their currency legal structure of their external debt. But in our statement, we also call for central banks to diversify the composition of the reserves and to use currency and interest rate hedging programs. So from your perspective as a former president of the Central Bank of Chile, how important is this recommendation? Is it easily implemented? What are the major constraints?
I think that's not it depends on where you go, but it's not a very difficult. I think that first of all, it's quite important and has been shown to be quite important for emerging market economies to have a cushion, a financial cushion, which is constituted by foreign exchange reserves. That's quite important. Whether they use it, they don't use it, how they strategically hold it. The evidence basically shows that's good to be prepared. Even this is an insurance, and that even deter speculators against your currency is quite important in periods, especially when there is turmoil. Now, what we have say in the statement is basically that there is a structural exposure to the US dollar, and this has two effects. One evaluation is a two type of valuation effects. First, the changes in the US dollar against other currencies, and second, the changes in interest rate that change the value of the asset. So now, whether this is central, and I don't know central, but it's sound to do and to have a better financial management. And here is where we discuss and we propose three things. First is a diversification of reserve assets. One can have some gold, also other currencies, convertible currencies of other advanced economies can provide some hedging. On top of that, also there are hedging instruments, direct forwards, currency swaps. It's quite important, for example, interest rate derivatives that can protect your balance from changes in interest rates, and there are swaps, and the use of instrument is not extremely complicated. Sometimes it could be expensive depending on the instrument that we are looking at and the hedging that we're trying to do. But for this, there is a lot of experience and things can be done. And then I think that also the third thing that we also suggest is in terms of the asset management of the duration and the fixed versus floating composition of the rates of advanced economy bonds. I think that also is quite important. Again, shorter duration helps to mitigate changes in the values of interest rate and valuation effect. So it's quite important, I think, that to strengthen and to hedge foreign exchange reserves, which have been proven to be quite a useful instrument to prevent financial turmoil in emerging market economies.
Thanks so much. Pablo, the last word is yours. You had important roles in both the public and the private sectors. So, among your recommendations for asset liability management, which one would you prioritize? If you could choose one, which one would you choose? You're muted. You're muted. You're muted. Try again.
Now,
Yeah.
okay. So I think that the important thing about having a strategy of managing external liquidity with also the structure of liability is essentially very important to reduce the vulnerability of a country to financial turbulence. I think that often countries are tempted to rely on short-term debt because they think the cost in terms of interest paid is lower. But as you accumulate short-term debt, you're increasing your vulnerability. So you need to have a higher liquidity if you face changing external conditions. So I think that the managing of assets and liabilities in this form should be viewed as an insurance policy. And I think that now many most, I think, emerging market economies understand this concept, and it is very important to take advantage of relatively favorable conditions as we have now to actually implement these strategies.
Very rich discussion. As always, we run out of time. I want to thank you all the presenters, but also I would like to put a QR code in the screen, if we may, please, to this QR takes you to our last CLAAF statements, both in English and in Spanish. So I hope that the audience got interested and are driven to take a further look to this. And we are, of course, ready to answer any of your further questions. With this, thank you very much to our CLAAF members that participated in this. And thank you, of course, to all of you, the audience. Bye-bye.
Bye, everyone.